It's the first Monetary Policy Committee meeting for the year 2021. Before this meeting, figures from the National Bureau of Statistics reveals economic indices that are not good for the country. This include the rise in inflation rate to 15.7% in December 2020, the highest rate recorded in 3 years. This is not to mention the economic recession in the country. But the central bank is adopting measures to drive growth.
The committee's current priority remains to quicken the pace of the recovery through sustained and targeted spending by the fiscal authority, supported by the central bank's interventions. In this light, it was thought necessary to increase collaboration with the fiscal authorities by providing complementary spending to finance productive ventures in a bid to improve aggregate supply and reduce prices.
There are also concerns raised by the Monetary Committee. These include how to address issues of rising debts, insecurity, and how to increase investment.
The committee thus called on the government to redouble its efforts at strengthening infrastructural efficiency and address the emerging security challenges in the country. In addition to this, the committee called on the government to explore the option of effective partnership with the private sector to improve funding sources necessary to address the huge infrastructural financing deficit. The committee expressed concern over the rising public debt stock as recurrent expenditure remain relatively high compared with capital expenditure, thus signaling future debt servicing challenges.
The economic outlook for the year 2021 remains gloomy, both at the global and domestic front. The Monetary Policy Committee is, however, hopeful that the procurement of vaccines remains key to reducing the impact of the coronavirus on the economy.
Let's get some insight into today's decision now. I'm now being joined on the news at 10 by the CEO, Financial Derivatives Company, Mr. Bismarck Rewane. Thanks a lot for joining us on the news at 10.
Thanks for having me.
And I can see you're smiling again because the last time we talked about it, you said the more things change,
the more they
remain the same. Here we are.
There we are.
What do you make of it?
To be honest with you, this was a more sober, honest, and objective communique. The analysts' opinions and those of the policymakers were more aligned. So that is where we agree. But I respectfully disagree on the therapy. Okay. While the diagnosis was very clear that there was a growth problem, but also there was more of an inflation problem. And that the therapy for inflation must include an rearrangement of the interest rate structure, which is important. And that is what it is. So, like the slides will show you, the chickens have come home to roost. Last time we had this meeting, the committee was very specific that at the end of the fourth quarter, we will get positive growth. At this time, but now they're more cautiously optimistic, more realistic, and in fact, I was impressed with that candor. Now let us look at where the facts and what the facts tell us. You see, that's the W curve there, which shows you that growth, we are going to recover from negative growth sometime in the second quarter, maybe the third quarter, but more like second and third quarter of 2021. If we get there earlier, good, but I won't hang my hat on that. Then this thing called inflation, which we call the thief of value. And I want to express this so that Nigerian viewers can say, if you kept 1,000 naira under your mattress on January 1st, 2019, in 2019, you would have lost 12% of that. And in 2020, if you didn't take it out and invest it, you will lose another 16%. So in all, you will lose 28%. Your 1,000 naira you kept under your mattress will only buy you 730 naira worth of goods in January 2021. If you kept $1,000 under your mattress, 2 years later, you'll get $997. You would have lost only $3. If you kept 1,000 cedis, Ghanaian cedis, under your mattress, you would have 821 cedis. You would have lost 18%. So inflation, like Milton Friedman says, inflation is legislation. No, inflation is legislation without, without taxation without legislation. That's what it's called. Now, why is inflation high in Nigeria? There are many reasons, but one of the key reasons is because money supply growth is increasing rapidly. And if you look at the graphs, show you very clearly that in the last 4 quarters, we've had money supply growing at 7%, 12%, 13%, 21%, and 26%. And inflation has gone all the way from 12 all the way to 15.75, and food inflation approximately 20%. But that's not the only culprit. You have devaluation effect. Currency was adjusted. Central bank alluded to that. Logistics and distribution costs, Boko Haram, supply chain disruptions, ways and means advances.
Well, how much of that inflation is owing to borrowing, federal government borrowing, for instance, keeping your eye on what Fitch was saying about the percentage?
Well, ways and means advances typically is printing money, okay? And when you print money, that's what happens. However, there's nothing wrong with the central bank lending money to the federal government. That is their job. They are the lender of last resort to the banks and banker of the government. However, at what price? If the government is borrowing at 0.5% or 1%, and the rate of inflation is 16%, you are losing money by going to bed. Wow. And that is the major cause. It's not the only cause. It's not a binary choice. It's not either or. It is a major contributor. It's as old as, you may know, Milton Friedman, everybody has said it, that once you increase money supply and goods output remains static, this is what happens. So what the central bank is saying, we need to increase output. We need to, but the time between when you start the policies on increasing output and when you get the result, it's going to take some time. That's why monetary policy is for very short tactical responses, while fiscal policy is for long-term structural shifts. But the two are happening at the same time. Luckily, there's a collaboration and there's an alignment. So you're going to see, and that's why we see the W curve. Output is going to increase, especially when the central bank begins to release more foreign exchange into the market. Manufacturers will grow. So where is it going to come from? The growth is going to come from, one, first of all, inflation is going to be corrected because you reduce M2 growth. You change the interest rate structure so that interest rates get closer to the rate of inflation. And you can see from our countries, look at South Africa. South Africa's inflation rate is 3.1. Its interest rate is 3.4585. South Africa has a 16-year low inflation, even though the economy is actually struggling, right? So what do we need to do? The areas that we can, agric, manufacturing, petroleum, trade. These are the areas that will grow, and you are going to see agric actually grew by 1.39 thanks to the Anchor Borrows program. But you see, the quantum is not enough to move the needle. So how does this affect the ordinary man sitting down, the viewers out there? Basically, we looked at 10 products. Of these 10 products, in the last 12 months, from January 2020 to 2021, the average increase in price of these products was about 72%, even though inflation is 15.75. What are these products? Yam went from 600 to 1,000 naira, 66%. Gari went from 7,200 to 13,700, 90%. Beans went from 15,000 to 22,000, 40%. Onions has come down to normal, thanks to Central Bank Anchor's borrow program, 25,000 to 40,000, 60%. Look at pepper. Pepper is 6,000, gone up to 14,000, 133%. Nigerians are spicy, they like their food tasty. Flour has gone from 8,500 to 14,500, and cement has gone up by 44%. So, in conclusion, let us say this. The good news is that external reserves, central bank has been able to make the external reserves increase to $36.52 billion, which is very comfortable.
So in terms of our outlook now, yeah.
Now, oil prices are at $56, and that's good. And Anchor Borrows program continues to do. But the difficulties remain forex rationing. We've got to stop that. The exchange rate pressures, we need to have exchange rate flexibility. And external debt, like the central bank alluded to, we need to manage that. So, in closing, GDP numbers are going to come out on February 22nd. Our estimates are that it will be about -4, but bringing the average for the year to something like -3 and something. General inflation is due out on February 16th. February 16th, we think it's going to be 16%. Not coincidence, 16 and 16. Currency pressures, the central bank is going to manage that, and that's in control. The CBN may likely, all things being equal, move interest rates the other way because the interest rate gap of 16 and 1% is too wide. So, generally speaking, it's not a bad day, but nothing dramatic is going to change until sometime next month.
Always a pleasure to speak to you, CEO of Financial Derivatives Company, Mr. Bismarck Rewane. Thanks for that.
Thanks for having me.
Yeah.